This is the video about using log scaling on your charts using Technician software. In many areas of technical analysis, it is necessary to compare two bits of unlike data, apples and oranges if you will. These can be the price of stocks versus bonds or single items price versus its momentum. But when analyzing an item or market over the long term, it is common to compare trends and price patterns at different price levels. If prices have not moved much in relation to their absolute level, ordinary arithmetic or linear scaling is sufficient. For example, a stock traded in a 7-point range centered on a price of 93 for the past decade. In percentage terms, 7 over 93 is about 7.5%, not much. But when prices move in large percentages, trendline construction can be subjective and analysis unreliable. Logarithmic or log scaling overcomes this problem. Rather than simply plotting price on the vertical axis, in a linear fashion, prices are plotted to indicate percentage changes. This means that the vertical distance drawn for an item that doubles in price is the same whether it goes from 5 to 10 or 100 to 200. A linear scale would plot the same vertical distance from 5 to 10 as it would for 100 to 105. So this is a chart of Netflix, and it's in weekly format for several years. It rallied sharply over here and over here, but in 2015 it really looks very steep. Was it an extraordinary move? This chart is regular or linear scaling. Now let's see what happens if we put this chart into log scaling. Oops, make a little adjustment. Looks quite different. Here is what we thought was some extraordinary move, when the real extraordinary moves happened much earlier, here and in 2013 especially. Okay, let's move on to the next one. This is Biogen, and we'll put it back into linear, and you'll see why I did that. This first trend line, while accurate and drawn properly according to classical trendline techniques, was rather useless in 2013, 14, and most of 15. It would have been better to switch to a shorter trend line from here, and that really described the action better. But again, let's put it back into that log scaling. Those two trend lines are still both there, but now they sit on top of each other. And that tells us that this is a pretty good trend line because it works in linear and log scaling. And by trend line, I mean this shorter one here from 2013. So when price broke, it was a pretty powerful signal to get out. Now, as trend lines often do, they come back in the future to work once again. So as you can see, back in linear, recent action has brought it back down to this trend line, but that's a discussion for another time. So in conclusion, logarithmic scaling is sometimes called ratio scaling, and perhaps that is a better name. It tries to measure changes in value rather than absolute prices. For example, if you have a portfolio and you have it equally invested in two securities, one at 10 and one at 100, and then both markets rise 90 points. The first security is worth 100, the second is worth 190. However, the first went up 10 times in value, and the second only 0.9 times. In other words, significantly more profits were generated in the first security, and the chart should reflect that. Log scaling allows the trader to see a clearer picture of percentage changes than arithmetic scaling does when markets move to different price levels. For short-term trading, any scaling works fine. But when a significant price move takes place, as in a multi-year chart, log scaling should definitely be part of the analysis.